let's start it off with its most basic. Go to the very beginning here. Maybe you're going to do an infill lot. You're going to build your own property, right? What kind of financing is in play here? What would you guys do?
You're going to go residential. You're probably going to have to do 20% down. Depends on if you're able to wrap your lot into it, which you should be able to. Sometimes it all depends. Sometimes they're going to want you to put 30% down and put a little more skin in the game, but you're going to go residential.
Well, and I would be on the unit count too. If it's
Depends on the building.
Yeah.
Yeah.
Well, I was thinking you were meaning single family infill. So sorry.
and you're right.
Okay.
That's
Some infill, there's some good opportunities, 1 to 3 acres that are bigger units, 30 or 5+ units, I should say, that could be 30 or 100 units infill.
yeah. So the question is the land already approved, right? Is it permitted? Is it approved for a certain kind of a building? So in that case, right, do you own the lot or do you not, right? The lot counts as equity in the deal. So if a lender's only willing to go up to 70 cents on the dollar as to what they're going to loan you, and maybe you own the lot free and clear, you inherited it or something, that goes towards your equity, and you might be able to get a construction loan just for what's called your vertical costs, right? Actually building the building, right? How does it get different though when we're talking about land that is not approved? Maybe it's not subdivided or entitled. Well, how does the financing become different there? Any thoughts?
From my understanding, when you're getting a loan on a piece of dirt or some land, it's interest only. Terms aren't going to be as good. They're probably going to want to see a good chunk of money down, at least probably 30, maybe 35% down. So yeah, if you're buying a piece of property for $1 million, you're going to be into it at least 300,000, maybe a little bit more, interest only.
And I think some people are going to go the hard money route too.
Right. Because there's loans through banks where you fit a certain, there's a loose set of parameters, right? I know that if I can check these 5 boxes, a bank is probably going to give me a loan, but hard money is when banks don't want to give me a loan. That's why I'm willing to pay the astronomical interest rate that comes with hard money, right? And that's all a question of risk.
Or do I need to close pretty quick? So I'm going to use hard money to close, and then you can flip yourself out of it with a construction loan of some kind. But
correct. So the first step listeners have to take in mind is my land entitled and approved? Does it have permits? You might be able to just get a construction loan depending on how much money you're bringing to the deal. But are you subdividing? Are you actually developing dirt? You're going to need private capital or A&D capital.
You're listening to the Build to Rent podcast with Steve Olson, Chase Levitt, and Sherida Zanger.